Hi, everyone. I'm Steve LaValle, CEO of WonderBotz. Welcome to CEO Chatz. Today, I have the distinct pleasure of having Martha Amram with me. She is an expert in ESG. But Martha, why don't we get started by you just kind of giving an introduction to yourself and your firm, and then we'll get started.
Thanks, Steve, and thanks for having me here. So I'm Martha Amram, founder and CEO of GLYNT.AI, and GLYNT produces sustainability data as rigorously as financial data, so it can be used in financial reporting and climate disclosures. My own background is I have a PhD in finance and economics from MIT. I worked in the MIT Energy Lab. So as sustainability, which is water, waste, energy, and emissions, becomes a critical non-financial piece of data that's included in financial reporting, analyses, and regulatory disclosures, you can see it all coming back together, like derivatives, options, futures, financial engineering, but now on climate-based instruments. And so I'm having a field day with GLYNT as we bring all of this data into ordinary business processes.
So I mean, we're looking right now at this huge tidal wave of change associated with ESG. But why don't we just start off with, I want to do like a rapid fire questions with you, Martha, if that's okay, just to make sure that everybody's kind of grounded in what it is. So just like, what does ESG stand for? Why don't we just start with that?
Yeah, so E, S, and G, three initials. E is environmental, S is societal, and G is governance. So under E, you'd be looking at obviously your carbon emissions or equivalents to the atmosphere. Under societal, it's about diversity in hiring, having gender diversity on boards, and so on. And under governance, it is those processes that keep companies out of trouble, both at the board level, at the senior management level, and so on. So when we adopted Sarbanes-Oxley maybe 12 years ago, that started the governance movement. It's now continuing into ESG.
Now, okay, so in a company today, in your opinion, or the collective wisdom of this industry, who needs to be the master of ESG in an organization today?
That has changed this past year, and I'm really glad you asked that question. 2 years ago, 3 years ago, it would have been sustainability as a function, maybe reporting into legal or up to the CFO in some manner. Today, it is all about finance. And the reason it shifted is that finance is in charge of disclosures, and you can get in trouble for greenwashing. There's lawsuits out there, and the CFO is the one that discloses and also has to lead the defense. So today it is all about finance. Now CFOs and the team that support them. So we might think of the folks maybe one notch lower, the controllers, the ESG controllers, and so on. They're going to be the party really on the hot seat right now.
And so we hear a lot about scope 1, scope 2, and scope 3 in ESG. Like, what does that mean?
So when the emission standards were set about 25 years ago, it was not done with a business intent in mind. It was really done from that lens of working to reduce carbon emissions. So they have categorizations and nomenclatures that can be quite confusing to folks in finance and business processes. I think the easiest way to think about it is, does a company emit directly into the atmosphere? Some do, maybe through boilers, maybe through making chemicals and so on. And that is categorized as scope 1 type emissions. Actually, even just driving a car, a company-owned car, could give you scope 1 emissions as a car has exhaust into the atmosphere. The rest of it could be divided into scope 2 and scope 3 in categories of each, but it's basically, hey, I bought stuff and that stuff took carbon emissions to make. So you might have carbon emissions in your utility bill, that's often known as scope 2. And you might have carbon emissions in your supply chain, that's part of scope 3. But you could also have emissions in your business travel, and that's another subcategory of scope 3. So anything that you buy has emissions, and that's part of scope 2 or scope 3.
So it's a little complicated for a layperson to understand, but I guess in its essence of what you said, sometime in the past, somebody bucketed all these things and they just happen to call it scope 1, scope 2, and scope 3. And And there's maybe not a lot of, you try to put a little rhyme and reason around it. Maybe there is, maybe there isn't, but it sounds like maybe not as much as we would like if we were doing it with like a very rigorous thinking here. But it's just what it is.
That's exactly it. Yeah, sorry to interrupt you, but that's exactly right. It has this nomenclature that maybe we don't want to keep anymore. So we can think about, what do I directly emit as a company, and what have I bought through various ways. Even employee travel is buying somebody else's fuel use and turning it into my emissions. So what did I do? What did I buy? So what did I do is scope 1. What did I buy is scope 2 and 3.
Awesome. Maybe that's a simpler way for people. We'll see if the rest of the industry picks up on that. So let me I jump right in. Let me back up a bit. So I'm Steve LaValle. I'm the CEO of WonderBotz. We are an intelligent automation firm. We've been in business for many years. We started with RPA. We moved on to OCR, IDP, sensors, and now adding artificial intelligence into around the services that we provide for our clients. And when we do our services, we do them around the use cases and the value that we provide. And this is why and then we do a lot in the finance and accounting function. And this is why we found the GLYNT partnership so intriguing, because we do finance and accounting today. We understand how those processes work, whether it's accounts payable, accounts receivable, or the accounting and the reconciliation function. And the ESG movement is moving into finance and accounting. So we thought if we paired up with GLYNT, that we could make it easier for people to embrace these new requirements and make it easy to adopt and comply. So all, particularly now that it's sitting in the office of the CFO, which is kind of where WonderBotz has its strength. So then I guess when you look at, so this is really a big change, Martha, right? And the change itself is movement, as you say, from a non-financial rigor to a financial rigor. And you said something in our pre-meeting, the business of climate, which I thought that was a really interesting topic. So could you expand a bit, for our listeners here, what is the business of climate, and why should we care?
That is what's driving this change. And so we've all heard about those BlackRock letters that were sent out to say, hey, we really care about climate risk. But I think lost in the noise about the politics of all that is some data. And the data is that the losses due to hurricanes and tornadoes and wildfires are mounting. And it's so bad that in California, homeowners can no longer buy insurance for their homes against wildfires across the entire state. And so you might say, well, how could a coastal house in California be subject to wildfires? But wildfires are putting the whole electric grid at risk. And thus you see there's real consequence to climate change. The economics are mounting up, and it's sort of contagious across a larger footprint than the house that got burned down. That's the business of climate, addressing that kind of risk in a systematic way so that we can navigate our future. Of course, we'd all like to avoid climate change that hurts us and brings these losses forward, but it is happening. It is happening in certain places and hotspots. So how does the financial engine of a company look to see that and avoid that risk?
Yeah, awesome. And because, we hear a lot about the regulatory side of this, but there is a business side of this, which is legit, which is, as you just say, very legitimate. There's risk involved to the ongoing operations. There's expenses that can be avoided with this. So it's not just an expense item. There's value that can be extracted by applying these principles and thinking about your carbon consumption, because carbon consumption is consumption, and consumption costs money. So that if we can reduce consumption and build plans to reduce consumption, that will also fall to the bottom line of organizations. But could you, again, from a context, like this is coming at everybody really fast right now. I mean, it's already here. I don't hear a lot of talk in the market on it right now, but it's here. Can you talk about, despite the fact that it's a good thing to do for your business, like if you don't do it, or like where are people at right now in terms of like how fast they need to move? I know it's different a little bit around the globe. Can you talk from a regulatory side, the compulsory reporting that needs to start happening?
Sure. There's pretty much 5 different ways to look at what is mandated. We've got the EU in the lead, the UK very harmonized with them, the US lagging, and Canada somewhere between the Europeans and the US. Then we also have excellent leadership out of Singapore and Southeast Asia. So when you put that all together, what we see is the EU is setting the stage, and pretty much everybody else, maybe within 9 months, is going to have the same rules. In the EU, for calendar year 25, 50,000 companies must report their emissions to the EU, and they do it on 2024 data. Now we're here in the middle of 23, so that you're going like, oh my God, all my emissions have to be kind of figured out, and I have to really have automated flows by the start of 24, because during that year, I've got to prepare my data, and you have to get it audited before you actually report it. So it becomes very much like financial data. The same system is in place in the UK, Canada following. And then in the US, we have the Securities and Exchange Commission, who's put out some proposed regulations. We expect them to be finalized in the next 2 months. I expect them to be largely compliant with the EU. So we will see over the next course of the next 18 months, about 100,000 companies outside the US being required to file emissions reports, and 13,000 companies inside the US either filing with the Security and Exchange Commissions or getting caught in the regulatory filings of the EU, which will hit you if you have 150 million in sales in the EU or 250 employees in the EU.
I mean, if you think about it, you're talking, we talk often about Fortune 500, Fortune 1000. You're talking 50,000, right? So this is not just a problem for the big companies. This is a problem for mid-market, or maybe even bordering on smaller market, but definitely mid-market on this side, right? You're saying if it's either employee count, so it's 250 employees, or the equivalent of 150 million euros or dollars in the euro dollars.
I translated it to dollars, but roughly about, they're almost at par many days. Okay. And the other thing that's, it's just happening very fast, and it's very widespread. So we've been through this kind of scenario before with Sarbanes-Oxley. Every US company had to start dealing with that. And of course, it was the public companies that were most affected, but then they would turn around to their customers and trading partners and say, look, I got to make sure you're not going to cause me a problem. So it was a little bit more contagious than to those who were forced to report. That market grew from 0 to 6 billion for companies like yours and mine in terms of market demand. Within 4 years, there was 6 billion in demand that had not existed.
Yeah.
But when you look at the Securities and Exchange Commission and the EU, as regulators, they have to report out something called the burden of regulation, which is their estimated cost of compliance. And they add up to 14 billion. So the regulators alone see this market going from 0 to 14 billion over the next 4 years. And I think you and I, your company, WonderBotz, and ours is both doing the processes, and then we do data. Of course, we're not doing all of the advisory services and so on. We're out there doing the pieces that we do so well. So our part of the market might be as big as the entire Sarbanes-Oxley experience.
Yeah, that is astounding. I mean, it's a staggering cost, and it's staggering into how far down it's going into business, right? These are not big companies. That were 250 employees is not necessarily that big a company, to be honest. I mean, it's a big company, don't get me wrong, but it's for regulation. They might not be used to being regulated like this because it's not. Well, I don't think it's as common.
Yeah, in the United States, perhaps not, but I do think in the EU, there's more of there's a different paradigm. But you're right, it's coming really fast, and it's very big, and it's incredibly transformational as well. Because and this is all of a sudden it becomes not like a nice to have, I want to go out and save the world, but the EU is very serious about doing taking on a leadership role to arrest climate change. And the way to arrest it is to curtail emissions. So in those regulations that we just mentioned, it's not just put your data out there. You have to have a reduction plan. You have to show your operating expense to that plan, your capital expense. And most reduction plans take a couple of years to ideate, deploy, and measure results. So let's say somewhere between 18 and 36 months. That is totally a financial planning exercise over multiple quarters. It is not I just bought my solution idea. Yeah. Now we have the capital of the company being interchanged for how much emissions you want to reduce. Suddenly, this is hugely operational, and you can see why the CFO is in charge, and you can see why there's a whole business to climate.
Yeah, without a doubt. So as we were coming together to figure out how we were going to help organizations to get started on this, we had the clear idea to help them start with a problem that they're already having, which is in the invoice processing area, particularly in the utility space. And of course, the utilities is such a big part of many companies' carbon, most companies, assuming you don't have like a factory or something that you're doing other emissions on, is a big part of the E component of the ESG. So, from your experience here, if, by helping our clients master the utility invoicing component with speed, so that not only do we figure out how to start with carbon plans, but we can actually avoid late fees and eliminate pay aheads and obviously stop disconnects from things not being paid, which nobody wants that. Like how would starting with utility invoices, how is that the right strategy for a company who really is trying to figure out how to embrace this new climate business of climate?
I really appreciate the focus here on the utility invoices. So every company gets, let's say 10,000 invoices a month, and buried in there will be their utility invoices. And those are key to all that kind of regulatory disclosures that we've been mentioning, because they're the primary source data. And as you get your data audited, you got to know where you started, and then you know how you got there. And it does require a rigorous financial accounting process. And today, companies do two things on utility bills. They just throw them into the general AP system, and it goes to a human because they're so different and so complicated, they become an exception to the straight-through processing. Or companies just bypass AP in the first place and have a dedicated staff to manage and pay the bills. Either way, you have a pretty expensive process that's not very reliable. By taking WonderBotz automation of the whole flow of AP processing and putting it together with GLYNT's expertise, we can whittle down that exceptions pile and do it faster. That's the point of automation, with reliability. That allows those bills to get paid. And you're right, it's kind of crazy, but most utilities require that their utility bills be paid in 14 to 21 business days after the statement is issued. If they send it to you via mail, you're talking about 5 days to get the invoice. If they post it online, it's typically a 36-hour posting cycle. So still, you've lost time, and you have just a small window of days in order to avoid late fees, disconnects, or as you mentioned, some folks want to avoid that mess, so they prepay their bills. They have thousands and hundreds of thousands of dollars of working capital in the hands of utilities.
Martha, that's 100% agreed. And then also the byproduct of combining the payment process of invoices with the ESG process is when we do the payments, we're approaching that with obvious financial rigor, because companies, you don't want to pay the invoice twice. You have to pay what you owe. You're managing all that. And by adding ESG into a financial payment process, we're sort of inheriting the financial rigor that's already a top priority for organizations in that space. Again, because I think part of this process, as it moves from some group maybe reporting up to legal into a CFO's organization, is to try to make it a familiar financial process, so that we know what financial rigor looks like, because we do that every day. Now we want to take this carbon accounting and we want to give that the same financial rigor. And the core to financial rigor is, of course, is being able to trace back to the source. So if we have confidence in the source, apply the methods. I know the methods are changing in the marketplace right now in terms of committees. I mean, you're flying off to London tomorrow, I think, to participate in one of those groups, and then to take the results of the methods and then make sure that that information is stored and readily available for management sign off, and then for third party auditors to come in.
You really nailed the two key things, which is, financial data is reliable. So we are at a good place, and I think a lot of it also is due to Sarbanes-Oxley, where you could take data coming out of your system after it's been touched by WonderBotz, and it was all ready to go. It can be audited, and it can go into financial planning software. And I always think of financial planning software as the litmus test on data quality, because if the number's off by a factor of 10, it blows up and makes the pictures and the numbers in that planning cycle look terrible, and it just stands out. So we know where it has to go. And as you point out, all this carbon data is now going into financial planning, and it's also going into audits. So for those two reasons, and those two outcomes, sustainability data has to be reliable in the same way that financial data is reliable. I know it's not going to blow up on me. I know I can make predictions from it. I can trust this. That's new to the sustainability market. And I would conclude by saying, take 10 public companies, go look at their emissions reports and check the math. You will find that on some rows, 2 + 2 = 7, because someone typed in the data into the final sustainability report that went out to market. It hasn't been produced in the kind of system we're talking about.
When you say the Sarbanes-Oxley, if you we remember, because we lived through all that, of course, showing our age a little bit. One of the things that it did was many companies used to rely on spreadsheets for key financial information. And that was part of what was dubbed at the time end user computing. And the problem with end user computing is that, if Mary Jane built a spreadsheet with a macro in it, she may have forgotten what it did. She may have left the company, and nobody really understands how that works. And Sarbanes-Oxley changed all that, and the ESG regulations are going to do the same right now. So we're going to make it a rigorous, reliable, auditable process. And as you say, it's going into systems. Some of these systems don't exist yet. So like that's stuff that the market's still figuring out. So I guess, Martha, as we kind of get ready to wrap here, do you have any closing comments that you'd like to share with the crowd?
Yeah, I think you're right about spreadsheets. We're still, and it's a great phrase in end-use computing. We're still seeing a lot of that. And one thing we didn't mention is in the last 3 weeks or so, the EU is, they're not being nice to do. They're saying this is a must to do. And to put some meat on that, they laid out their structure of fines. There are significant fines if you don't comply, if you don't report, and it can be up to 5% of your revenue. And so when we think about spreadsheets against the magnitude of the fines, they're like, nope, we've moved well beyond that spreadsheet world. And that's where the business of climate is today. As we started, it's about these everyday business processes being brought into the financial processes and adopting the same rigor.
Yeah, Martha, excellent. Thank you so much for sharing your insights. I know this is a rapidly changing situation. What we're going to do, normally I would put up, I might close, but I think in this case, we're going to stand up a web page, and there's going to be a link that's going to appear on the screen, and where Martha and I are going to continue to try to give the current thinking around what companies need to know. So, please take a moment after this to click on that, and this video will be there, or the stream will be there again. But we'll also be putting in updates and other types of information that will be helpful to organizations that are starting to determine how to adopt and operate within the business of climate. So again, thank you very much, Martha. Thank you. I'm Steve LaValle. This is CEO Chatz. Thank you. Have a great day.